All right, we'll go ahead and get started because I want to be respectful for everybody's time out there. So I do appreciate you taking the time out of your busy days to join us here. It was a big bill that was passed. So there's a lot of stuff in it, and our thought process was to jump on a webinar and try to educate as many as possible on the changes that had take place in the bill. And what you can look forward to come tax time when you file next year's taxes in 2026 for tax year 2025. A couple admin notes to get out of the way. The webinar is being recorded, and I will post it up to our YouTube channel this afternoon after I do some edits on it, and we'll get that up there. It's at Guardian Accounting Group is the YouTube channel, so you can look for it there if you have to leave for any reason, or if you want to share this with others out there, please share the link when it's available. Also, there is a Q&A section. So as we go through this presentation, please, if you've got some questions, you can put them in that Q&A. I will run down in order once we finish. I'm anticipating being done at about 30 to 35 minutes, maybe a smidge longer, but we'll take some time there at the end and go through all of the questions that you guys have. I'm sure there's going to be quite a bit. So with that, let's go ahead and get started on the Guardian Accounting Group's version of the One Big Beautiful Bill tax summary that we are. My name is Steve Ribble. I'm an enrolled agent and owner of Guardian Accounting Group here in Tampa, Florida. So I appreciate you guys showing up today and learning some more about this bill, the One Big Beautiful Bill, as it is nicknamed, and OB3, as we like to call it here at Guardian Accounting Group. So when you hear me reference OB3, I am referencing the One Big Beautiful Bill. Most of the tax law changes are going to be extensions from the Tax Cut and Jobs Act of 2017. So we will be spending some time to go through those changes and then talk about how OB3 has enhanced them or changed them going forward in the current tax laws. So again, let's go ahead and jump right in here. The Tax Cut and Jobs Act of 2017 was actually one of the most important overhauls of the U.S. tax code that we'd seen in decades. It changed how millions of us pay taxes. Its passage marked a major legislative victory for Republicans at that time, who controlled both chambers of Congress, and they sought to achieve tax reform as the cornerstone of their agenda. But like most legislation, the act passed on strict party lines. So there was no Democratic support at any stage of the Tax Cut and Jobs Act of 2017. Proponents argued that it would stimulate economic growth, create jobs, and make the U.S. more competitive globally. But the critics contended that it disproportionately benefited corporations and the wealthy, increased the federal tax deficit, and provided limited long-term relief for middle-class taxpayers. Well, here's the problem. The Republicans knew they wouldn't get enough support to pass the bill over a Democratic filibuster. So they passed it through a process that was called a budget reconciliation. That let them get it over the goal line with a simple majority, not subject to Democratic filibuster. And it's an important but, the reconciliation bills can't increase the deficit more than 10 years out. That in turn means that most of the individual tax provisions were scheduled to sunset or expire December 31st of this year. So whichever way the election went, we knew that the administration that was going to be in the office was going to have to address tax reform of some kind. The Urban Brookings Tax Policy Center estimated that if those rules expired at the end of this year, 70% of Americans would see higher taxes. Now, that obviously was unacceptable to both parties. And so the only real debate was over how much of the current law was going to survive. Congressman Jason Smith, who chairs the House Ways and Means Committee, actually called it the Super Bowl of taxes. So on May 25th this year, House Republicans proposed a 976-page draft of the package dubbed the One Big Beautiful Bill, OB3, and that kicked off an intense 6 week of legislative horse trading in the House and the Senate. The bill was passed by razor-thin margins on both chambers, but there aren't any style points in Congress. It's a pass or fail system, and this bill is law right now, just as if it had passed with a unanimous votes. Today, we're going to walk through some of the more important individual income tax provisions and a few of the business tax provisions that you'll see in next year when you file your taxes. We're going to try to stay away from any partisan commentary. My goal is for you to leave this webinar with a better understanding of how this bill is going to impact you and your families. If you'll allow me a little indulgence for anybody that isn't familiar with Guardian Accounting Group that might be on the presentation today, we are a full service accounting firm. We're located in Tampa, Florida, beautiful sunny Tampa, Florida. But we actually work with individuals and small businesses all over the country. So we're not geographically bound. On staff, we've got 3 enrolled agents, including myself. We've got a CPA on staff, and I've actually got 2 enrolled agents in training right now. So we've got a pretty robust crew here at Guardian. We offer monthly and quarterly bookkeeping services and sales tax filings for small to mid-sized businesses, payroll services for small and mid-sized businesses and self-employed individuals. We do financial report preparation for business loans and mortgages, and proactive tax planning for businesses owners and high net worth individuals. And of course, the bulk of what we do is income tax preparation for individuals, businesses, nonprofits, and estates and trust. There's not any kind of tax situation, honestly, that we or my crew have not seen out there. So we're very experienced and ready to help anybody out there. So appreciate the indulgence there, but let's jump back into what we're all here for. What exactly did the 2017 Act accomplish that the current administrator wanted so desperately to extend? We're going to focus on 7 key changes at the individual level today. As you'll see in the next slide, this is back in 2017, they started with lower personal rates almost across the board. This made the biggest change in Americans' tax bills, and it turns out it is the most expensive component to extend. Standard deductions doubled, although personal exemptions disappeared. The child tax credit increased. It actually went up even further during the pandemic, if you guys remember that, but then it's come back down. There's a new category of income that was created called qualified business income to avoid disadvantaging pass-through businesses in the face of lower corporate taxes. Depreciation rules changed, allowing for faster deductions of capital equipment. The deduction for state and local taxes, or SALT, got capped at $10,000. And finally, estate tax exemptions doubled. Slides here. So you can see this slide, the biggest change back in 2017 was simply cutting the tax rates. On the chart, everything outside of the 10% bracket was reduced. OB3 makes this rate structure permanent with no changes. So you're going to continue to see the same tax rates that you've seen in the past since 2017. Next, the 2017 Act nearly doubled the standard deductions. Those amounts went from $6,350 to $12,000 for single filers and $12,700 to $24,000 for joint filers. In exchange for those higher standard deductions, Washington eliminated the old personal exemptions, which stood at $4,050 for every filer, spouse, and dependent on a tax return. They also clipped some of the traditional itemized deductions, lowering the limit on mortgage interest from $1 million to $750,000. They capped, as we talked about, the SALT tax deduction at $10,000, and they eliminated the miscellaneous itemized deduction in category entirely. The most immediate impact of these changes back then was the cut in itemizers from roughly 30% of all taxpayers to just about 10%. Most families wound up paying less, although larger families that took advantage of the personal exemptions may have paid a little bit more. OB3 makes this higher standard deduction permanent. It even bumps up temporarily from 2025 through 2028. For 2025, it makes those standard deductions $15,750 for individuals, $23,625 for heads of household, and $31,500 for joint filers. Now, having said that, OB3 goes on to cap overall itemized deductions for taxpayers in the highest tax bracket, the 37% tax bracket. That's going to be effective starting 2026. Specifically, it reduces itemized deductions by 2/37 of the lesser of your total itemized deductions, or the amount by which your taxable income plus itemized deductions exceeds the 37% bracket. So let's give a round of applause for tax simplification there. If you don't understand that, don't worry, we do. In essence, what that's going to do is it's going to effectively cut the tax benefit of your deductions if you're in the highest bracket from 37% to about 35%. So a marginal reduction in your itemized deductions there. The 2017 Act significantly restructured the child tax credit, making it more accessible and beneficial to families. It doubled the credit from $1,000 to $2,000 per child under 17. It allowed for up to $1,400 of the credit to be refundable, meaning that families with zero tax liability were still going to benefit. It raised the income thresholds for phasing out the benefit, also expanding it to more families. Before the act, the phase out started at $75,000 for single filers and $110,000 for joint filers. After the act was passed, the phase out started at $200,000 for single filers and $400,000 for joint filers. Finally, the 2017 Act added a $500 non-refundable credit for children age 17 and older, elderly parents, and also other qualifying relatives. The difference between refundable and non-refundable credits, if you're not familiar with that, is a non-refundable credit will count against your tax liability only. And if there's any excess credit, it is non-refundable, meaning that you do not get it. A refundable credit will count against your tax liability, but if there is credit left over, the IRS will refund that back to you. So refundable credits are very, very valuable. So OB3 permanently doubles the credit from $1,000 to $2,000. It's going to add a temporary boost in 2025 through 2028 of $200. So you're actually going to get $2,200 per kid under 17. It's going to index those amounts for inflation for tax years beginning after 2026, which I think is a great thing. And finally, it makes the $500 credit for non-child dependents permanent. So all very good changes there. Let's see. The 2017 Act introduced significant changes to the depreciation rules, and this is where we're going to get into a few of the business changes. And it was aimed at encouraging investment in business assets. Key provisions at that time were increasing bonus depreciation rate to 100% for qualified property. That let businesses immediately deduct the full cost of eligible assets, such as machinery, equipment, and certain improvements in the year that they are placed in service. The deduction phased out or started phasing down after 2022, and it decreased annually by 20% until it reaches 0% or was scheduled to reach 0% in 2027. 2025, it was currently at 40% bonus depreciation. It extended the eligibility of bonus depreciation and first-year expensing to used property, provided that it's the taxpayer's first use of that property and it meets certain conditions. Increased the maximum deduction under Section 179 to $1 million with a phase-out threshold starting at $2.5 million. It also expanded the definition of qualifying property to include improvements to non-residential real property, such as roofs, HVAC, and security systems. It increased the depreciation caps for passenger automobiles, allowing for faster write-offs of vehicles placed in service. Now, overall, these changes made it easier for businesses to go out and purchase and expense new assets. OB3 is going to do a few things. It's going to restore 100% bonus depreciation on qualifying property placed in service after January 19th, 2025. So if you happen to have bought equipment prior to that date between January 1st and January 18th, you are going to be stuck at a 40% bonus depreciation. If you bought after that date, you will get 100% bonus depreciation on those assets. It expands the Section 179 first-year expense capping to now $2.5 million, with phase-outs beginning at $4 million. It lets businesses expense 100% of manufacturing facilities for projects started after January 19th, 2025, and before January 1st of 2029. And finally, it lets businesses choose between deducting 100% of domestic research and development costs or amortize those costs over the useful life of that research. So all good things coming for some businesses out there. Excuse me one second. The 2017 Act cut the top corporate tax rate on C corporations from 35% to a flat rate of 21%. Now, that's a lot less than the maximum of 37% you'd pay on income from sole proprietorships, partnerships, and S corporations. So in order to equalize the tax treatment between taxable and pass-through businesses, The act at that time created a new category of income referred to as qualified business income. And that, in essence, lets a business owner deduct 20% of his income from his taxable income in the current tax year. QBI includes net business income from sole proprietorships. It includes partnerships. It includes S corporations. It also includes pass-through income from real estate investment trusts. So you may have seen that on some of your dividends reported from your brokerage accounts, publicly traded partnerships, and also qualified agricultural co-ops. It does not include guaranteed payments to partners, and it doesn't include W-2 wages that you draw on your business. And it also doesn't include investment income like capital gains or interest income. However, there were three important limits on that deduction. First of all, if your 2025 taxable income after adjustments to income and itemized deductions is over 197,300 for single filers or 394,600 for joint filers, your QBI deduction starts to phase out. Secondly, if your QBI income comes from specified service businesses, and these would be businesses like medicine, law, accounting, actuarial science, financial services, and consulting and performing arts, or any business really that relies upon the reputation or skill of one or more employees. From those same income levels that I mentioned, 197,300 and 394,600, you will get a phase out of your QBI deduction for specified service business. And third, the overall QBI deduction is limited to 20% of your taxable income in any particular year. There's no provisions of carrying over any unused amount. And however, if your QBI for the year is negative, that loss will be carried forward into the next taxable year and count against the qualified business income during that time frame. OB3 is going to keep the general framework for QBI. It makes the QBI rules permanent at the 20% level. It does tinker with the phase-out rules to avoid income spikes near the threshold, and it expands eligibility to certain business development companies. The 2017 Act also created a new set of rules around something called a Qualified Opportunity Zone, or QOZ. These are low-income census tracts designed or designated by the U.S. Treasury where investors can earn preferential tax treatment for investing in capital gains in these areas. Under the Tax Cut and Jobs Act, investors got three big tax breaks when they rolled capital gains into a QOZ. First, you could defer paying tax on the capital gains by reinvesting those gains into a QOZ within 180 days. That deferral lasted until December 31st, 2026, or the date that you sold the investment in that QOZ. This includes gain from any investment. It could include stocks or a business that you sold or even cryptocurrency gains. You didn't even have to roll your entire sale proceeds into the QOZ. You could choose just to roll the capital gain portion over and roll your basis into something else. Secondly, if you held your QOZ investment long enough, you got a basis increase on your rollover, which effectively reduces your capital gains. Holding for 5 years got you a 10% exclusion. Holding for 7 years got you an additional 5% for a total of 15% exclusion on your capital gains tax. Finally, if you hold on to your QOZ investment for 10 years or more, you'll get to exclude the entire gain on that investment from your taxable income when you sell. That's what we refer to here at Guardian as the holy grail of tax planning. You get to buy low, you get to sell high, and you get to pay absolutely nothing. There are qualified opportunity funds that make it a little bit easier to invest in those QOZs, and they're specifically designed for this process. Now, OB3 introduces changes that make the QOZ program permanent, and they revise it in key aspects for sales and rollovers occurring after December 31st, 2026. You'll still have the same 180-day clock after you realize a gain to roll it into a fund. Gains will be deferred for 5 years from the rollover date. It continues the 10% basis increase on deferred gains you hold for the complete 5-year deferral period. It redefines which census tracts can qualify for the program. Under OB3, governors will now propose new QOZ zones to be effective July 1st, 2026, and again every 10 years thereafter. There are new and tighter rules on which census tracts will qualify. Finally, if you hold your rollover investment for more than 30 years, for those of you that are ultra long term, the gain elimination is frozen and your stepped up basis is capped at your property's fair market value as of the 30th anniversary of your rollover date. Let's talk a little bit about the SALT deduction. The $10,000 cap on the state and local tax deduction was a major point of debate when Congress debated this act back in 2017, particularly for residents in high income tax states. This was the one part of the act that Trump proposed not to extend. But it turned into a political football bouncing around in the end zone of Congress before they finally came to an agreement on it. Many elected officials, especially those from high income tax states like New York, California, New Jersey, they were pushing for the elimination or increasing of this cap. They argued it is disproportionately hurts middle and upper middle class taxpayers in their states, and it discourages economic growth. The fiscal reality, though, is that capping the SALT tax deduction was how Washington paid for many of the other tax cuts in the bill. The Committee for Responsible Federal Budget estimated that repealing the cap would have added $1.2 trillion to the deficit over the next 10 years. So you can see that it was an important component there for financing the other tax changes that we're seeing. In the end, there just wasn't enough room in the budget to eliminate the cap entirely. So what OB3 does is it raises the cap temporarily to $40,000 for tax years 2025 through 2029, regardless of your filing status. It begins phasing out for incomes above $500,000, but will not phase below the original $10,000 cap. The cap and phase out thresholds will both go up by 1% per year through 2029, but then in 2030, it's going to revert back to the cap of $10,000. So we're going to have it for a short period of time and give some relief to some of our clients up in New York and New Jersey and Chicago and California. All right, and then the estate tax. Now, excuse me. Finally, there's the estate tax. This isn't something that most Americans are going to have to worry about. But if you are one of the few, it can mean millions of dollars. Not to you much, but probably to your children and your grandchildren. The U.S. estate tax system utilizes what's called a unified credit exclusion, which lets you transfer a certain amount of assets without incurring federal estate taxes. This includes both lifetime gifts and transfers at death. For 2025, that amount is $13,999,000 per person and $27,998,000 per married couple. That amount is high enough that the IRS receives fewer than 10,000 estate tax returns every year, even fewer actually owing any tax. The tax itself is a flat 40% of anything above that amount, payable within 9 months of death. Now, the estate tax doesn't raise much revenue. It typically only raises about $25 billion a year. And I know that number might seem like a lot, but if you compare it to the overall $6 trillion budget, it's a drop in the bucket. It's mainly a symbolic and a political football, if you will. Without any extension, we would have expected the unified credit was going to drop to around $7 million per person beginning in 2026. However, OB3 raised the unified credit to a flat $15 million per person for singles and $30 million for joint returns, and that continued to be indexed for inflation going forward. Now, we've obviously seen, if you've seen anything on the bill, you've seen a lot on the green energy reductions that you're going to see coming. So this is what we're going to talk about on this slide. This goes back to the Biden administration and, excuse me, the Biden administration, and they made tax breaks for green energy development a central part of their climate and economic policy. And it was primarily through the 2022 Inflation Reduction Act. That act established or expanded over 20 tax credits aimed at accelerating the deployment of clean energy, electric vehicles, and even energy efficient buildings and low carbon manufacturing. The goal was to reduce household energy costs and support the growth of domestic clean industries. The current administration came into office in 2025 seeking to roll back the Biden administration's focus on green energy and redirect those dollars into other priorities. So here's what OB3 changes. It's going to eliminate tax credits for buying electric vehicles after September 30th, 2025. That includes the $7,500 credit for new vehicles and $4,000 credit for used vehicles. So if you were thinking about buying that Tesla or any other EV that qualifies, you're going to want to do that before September 30th of this year. It eliminates the 30% credit for residential solar systems installed after 2025. So you've got until December 31st, 2025 to get it operational, or you lose out on that 30% tax credit. And finally, the bill phases out the Inflation Reduction Act's incentive for commercial wind and solar developments, mainly by imposing a placed in service deadline of December 31st, 2027. Now, President Trump and every Republican running for Congress last year campaigned on extending the 2017 Act. That was clearly their highest tax priority. But Trump, like any other politician, threw out a bunch of new proposals on the trail. So I thought we would take a quick look and discuss those. First, Trump called to eliminate tax on tips. OB3 lets tipped workers exclude up to $25,000 of tipped income from their income taxes for 2025 through 2028 only. It phases out for single filers at 150,000 of adjusted gross income and joint filers at $300,000 for adjusted gross income. Now, before all of you on the webinar go out and try to restructure your pay to include tips, please keep in mind that it's only for industries that customarily receive tips income. That's going to be restaurants and salons, just to name a few of those industries. Second thing Trump proposed was eliminating income tax on overtime pay. OB3 actually lets eligible hourly workers avoid income tax and overtime pay. From that is going to also run from 2025 through 2028. That exclusion is also is limited to the 12,500 for single filers and 25,000 for joint filers. And it also has the same phase outs of $150,000 for single filers and $300,000 for joint filers. The IRS recently announced that they were delaying any changes to informational returns until 2026. So think your W-2s and your 1099 NECs or your 1099Ks. They're not going to change those until 2026. And what that means is they've informed the employers that they would need to report the tips and overtime pay directly to the employees for their tax purposes for 2025. So that'll be something that you're going to make sure you get from your employer before next tax season. The third thing Trump proposed was eliminating taxes on Social Security benefits. So right now, if you are single, those benefits are tax-free actually until your provisional income, which includes your regular income plus tax-free municipal bond income plus half of your Social Security benefits. If that hits $25,000, you'll owe tax on 50% of your benefits. Once your provisional income crosses $34,000, you'll be taxed on 85% of your Social Security benefits. If you and your spouse file jointly, benefits are tax-free until your provisional income reaches $32,000, at which point you'll be taxed on half of your benefits. And once your income tops $44,000, you'll owe tax on 85% of your benefits. Now, what OB3 does is it doesn't eliminate the tax on Social Security, but it does provide some relief for our senior taxpayers out there. You're going to get a temporary $6,000 increase in the standard deduction for seniors age 65 or older, and that would be $12,000 for joint filers if both are over the age of 65. And that's going to run from 2025 through 2028. It does start phasing out at incomes over $75,000 for single filers and $150,000 for joint filers. Now, these amounts are on top of the existing standard deductions for seniors. Seniors do get, for single filers, they do get an extra $2,000 standard deduction. And married couples, if both qualify, they get $1,600 each or $3,200 as a couple, in addition to their standard deduction. This $6,000 deduction is available to all seniors, though, regardless of whether you itemize or you take the standard deduction. So even if you itemize on your tax returns, you're still going to get an additional $6,000 deduction if you're over the age of 65. Finally, Trump floated the idea of creating a new deduction for interest on car loans. I know this is going to be helpful out there, especially considering the prices of new cars nowadays. I think the average is somewhere north of $48,000, which is just obviously insane. OB3 creates a new above line deduction. What that means is that you do not need to itemize to take this deduction. You can deduct up to $10,000 of interest per year on a new passenger vehicle as long as it was assembled in the United States. It phases out for incomes over $100,000 for single filers and $200,000 for joint filers. And it's good for new loans only taken out between 2025 and 2028. So if you have an existing loan on the car, that's not going to qualify. So it's got to be a new loan that you've started in 2025 all the way through 2028. Now, with any legislation this size and a 936 page bill I think would qualify as pretty large. You'll find members of Congress trying to sneak in pet proposals. They like to call it hanging ornaments on the Christmas tree. Utah Senator Mike Lee proposed to let the federal government sell millions of acres of federal lands ostensibly to provide affordable housing. The Senate voted 99-1 to eliminate a House provision banning states from regulating AI. And several legislators added provisions that were eventually stripped from the bill because they weren't germane under the budget reconciliation rules. These included things like a provision that was passed by the House to restrict federal courts from enforcing contempt orders against government officials unless the plaintiffs posted a bond, and a ban on using Medicaid money to pay for gender-affirming care. However, the final legislation does include several last-minute wildcard provisions that few of us in the industry saw coming. First of all, OB3 greatly expands tax breaks under the Code Section 1202 for qualified small business stock. This is sometimes referred to as the angel investor loophole, and it is especially popular with tech company founders. And as I explain why, you'll see. This is a big deal, and I think it's going to upend the entity selection planning process for a lot of new businesses going forward. Qualified small business stock refers to shares issued by an entity taxed as a C corporation with gross assets under 50 million or less at the time of issuance and immediately thereafter. If you hold those shares for 5 years or longer, you can exclude up to $10 million of gain or 10 times your base, whichever is higher, from your total income when you do sell the stock or sell the company. OB3 raises the gross asset limit to 75 million, and it raises the exclusion amount from 10 million to 15 million, and it indexes it for inflation. So very, very strong there. It also shortens the waiting period. You'll be able to exclude 50% of your gain if you hold the stock for 3 years and 75% of the gain if you hold it for 5 years. Secondly, OB3 cuts the itemized deduction for gambling losses. Under the previous law, if you itemize, you could deduct 100% of your gambling losses up to the amount of your gambling winnings. In other words, if you won more than you lost, you owed tax on the net gain. But if you lost more than you won, like most of us, if we're honest, you could avoid tax on your wins but got no breaks on your losses. OB3 cuts the deduction to 90% of your losses. So for example, if you were at the roulette tables or the slot machines and you won $100,000 at the slots and then immediately lost it all at the tables, you'll have to report the $100,000 gain on your taxes, and you'll only be able to write off $90,000 of the losses. And this all starts in 2026. Third, if you're in the business of whale hunting, and I know there's going to be a lot of you on the webinar that are into whale hunting, OB3 brings tax breaks to you as well. Seriously though, if you're wondering why such an oddball target rules kind of made it into this final bill, it was part of the Senate Majority Leader Thune's effort to secure Alaska Senator Lisa Murkowski's vote on OB3. That's why you're seeing some of these kind of funky things that are in this bill. OB3 is expanding the tax-free withdrawals from Section 529 college savings accounts. Beginning in 2026, the exclusion for withdrawals used for K through 12 tuition is going to increase from $10,000 to $20,000, and you can take tax-free withdrawals for 7 new categories of expenses: curriculum materials, books, online resources, tutoring, educational therapies for students with disabilities, and dual enrollment fees for college courses and also standardized test fees such as the SAT. Homeschooling expenses are also eligible for the first time. Um, OB3 adds another above the line deduction for charitable gifts. You can now deduct up to $1,000 for single filers and $2,000 for joint filers for qualified charitable donations, even if you don't itemize, which I think is an awesome thing. And I think it's going to help, as far as people being charitable to the nonprofits out there of the world. OB3 makes the adoption credit refundable up to $5,000 and it also indexes that amount to inflation. That means you'll get a cash refund of any amount of your qualifying credit that exceeds your actual tax up to $5,000. And finally, which we're actually getting a lot of questions on here at Guardian Accounting Group, OB3 creates Trump accounts for U.S. children born between January 1st of 2025 through December 31st of 2028. The government actually is going to deposit $1,000 into each account of each child born during that time frame. Families can also contribute up to $5,000 every year until the child reaches age 18. These funds are going to be deposited into low-cost index funds, and withdrawals are going to be restricted. At age 18, the child can access up to 50% of the account value for specific purposes, such as higher education or starting a business or buying a first home. At age 25, the full balance can be used for those same qualified purposes. And at age 30, the account holder may use the funds for any reason. Earnings grow tax deferred. Qualified withdrawals are taxed at long-term capital gains rates, and non-qualified withdrawals will be taxed as ordinary income. Before we finish, let's take a look at three more possibilities that could affect the tax environment now that OB3 has done most of the heavy lifting. First, I've mentioned that the corporate tax rules never had a scheduled expiration date like the individual rules. So I know Trump has proposed lowering the overall corporate rate to 20% and even perhaps 15% for companies that manufacture products here in the US. He's going to need Congress to help with that. But our point being is that you should keep in mind that permanent doesn't always mean permanent, especially when Washington is involved in that process. Secondly, Trump has fallen in love with tariffs, which he's actually referred to as the most beautiful word in the English language. I'm not here to debate the use of tariffs or whether they're good or whether they're bad. But I will say this, given that we buy about $3.2 trillion worth of goods and services abroad every year, even a flat 20% tariff rate across the board is only going to raise about $600 billion a year. And that's nowhere close to our $6+ trillion budget that we run. So our thought process, and I know people have been thinking he's going to eliminate the income tax. We just don't see that happening. Just the numbers just don't pencil out there from our estimation. So the income tax system is not going to go anywhere, unfortunately, folks. Third and finally, we should remember that this is Washington, and we are dealing with, as Mark Twain famously said, no man's life, no man's liberty, and no property are safe while the legislature is in session. So while OB3 extends the current rates like the administrator wanted, we can't take anything for granted, especially with future administrations that might come into power. So that was what we had today, guys. What'd you think about it? Hopefully you're optimistic that OB3 is going to power the economy and be a benefit to yourself. But let me know what questions you have out there today. We got any questions? You could throw them in the Q&A box if you've got anything.